Welcome, Ellen.
Thanks, Richard. I have a slideshow. Are they up? I have some slides. Oh, they're there? Okay, cool. Well, I can't possibly get through all my slides in 15 minutes, so I'll post them on my website, which is ellenbrown.com, and I'll do my best. But even though there's not enough time, I do want to take a little time to tell a story since we're doing storytelling. This is actually an email I got from someone who was a grandfather, and he said he was playing Monopoly with his granddaughter, his 5-year-old granddaughter, and we know Monopoly was a game created to show that in our current system, the rich get richer until they have everything. So he was getting kind of bored with the game, and she had all the chips, and he said, well, I'm out. I don't have any chips. I can't play anymore. And so she, this 5-year-old, gave him half her chips. So the point is that even a 5-year-old knows that if you want to keep the game going, you've got to share your chips. But that is not the system we have today. So what we have is something that looks like this, where you have, this is the disparity between rich and poor. So the rich get richer and the poor get poorer until it's unsustainable, the thing collapses, and then it happens again, the rich get. So we have bubbles and busts, booms and busts. The peak on the left is 1929, and then there was a collapse, and then we went along for it with a period of stability for a while, and then there was another peak over here on the right, that's 2008, which collapsed, but it didn't collapse to the extent that it did in 1929 because we had a new system where the government, meaning we the taxpayers, bailed out the culprits who were the too big to fail banks. So again, we have this widening disparity. I'm not sure what, oh there, okay. So Alan Greenspan admitted that there was a flaw in his theory. And what he said the flaw was that markets do not self-correct. In other words, that you need some regulation. If you let markets go by themselves, you'll get a chart like what we just saw. But I would say that the real flaw is something more fundamental, which is that in our system, banks themselves are allowed to and do create virtually all of our money supply, and they lend it back to us at interest. You can tell that from this chart of the money supply, which the top line is M2, which is the circulating money supply. The only money created by the government, which is where most people think money comes from, is about halfway up the red line. That's coins and dollar bills, and that's even assuming that the Federal Reserve, which issues dollar bills, is part of the government, which I would argue it isn't, since it's composed of 12 branches, all of which are 100% owned by the private banks in their district. But anyway, and then this chart doesn't even include M3, which is the shadow banking system, derivatives, et cetera. So there's a huge money system out there that is not created by the government. Money reformers have been saying for years that money is created by banks. But the Bank of England just admitted that a year ago in a directive where they said, banks do not act simply as intermediaries, lending out deposits that savers place with them, and nor do they multiply up central bank money to create new loans and deposits. Commercial banks create money in the form of bank deposits by making new loans. So money is created in the process of making a loan. And you might say, well, then why do they need our deposits? They obviously do. They're always trying to get them. The reason is that they have to balance their books at the end of the day. So there's a reserve requirement, let's say 10%. I mean, it varies a bit, but they have to keep a certain amount in a reserve account with the Federal Reserve. And at the end of the day, they have checks and money coming in and going out all day. And at the end of the day, if they don't have that 10%, in the reserve account, the Federal Reserve treats it as an automatic overdraft, and then they have to come up with the money somehow. So the cheapest place they can get that money is to borrow from their own depositors, and they borrow at, well, Chase Bank right now is paying 0.1%, and that's on, I think that's on time deposits. So that means if you leave $1,000 in the bank for a year, they will pay you $1. So they are getting this money very cheaply, or they can get it from the money market at 0.15%, or from other banks at the Fed funds rate of 0.25%, or from the Federal Reserve itself, the lender of last resort, at 0.75%. If they get it from other banks, the Fed funds rate, basically here's what's happened. Bank A, let's say you go to your bank and you take out a mortgage. You want $500,000 to pay for your new house. And so they will monetize your mortgage, essentially, turning your mortgage into a negotiable instrument, put that on one side of their books as an asset to themselves, and then put it on the other side of the books as a liability to themselves because they have to cover that $500,000 check when it goes out of the bank. So it goes into Bank B. Bank B now has $500,000 in excess deposits. Bank A is $500,000 short. So Bank A borrows from Bank B at 0.25%. So essentially, they've created the money. It's a check-kiting scheme. They've created the money. It goes into another bank. They borrow it back. So they borrow it back extremely cheaply, and they lend it to you at 5%, or if it could be a business loan at 8%. It could be credit cards at 16%. So they're making the difference between that very low rate that they paid for the money and what you're going to pay on it. So over the course of like 30 years on a mortgage, you're going to pay at least twice so you're going to pay $1 million back on that mortgage. And over the course of a 30-year bond issue, the government, local governments will pay double. So they're paying 50% of what local governments pay for infrastructure goes to interest. So the way we can recapture that interest is to own the bank. But this is what we have today, where does that interest come from? Because virtually all money is created by banks when they make loans. It can only come from somebody else taking out another loan at interest. So you have this voracious sort of more and more debt supporting the lenders at the top until the whole thing collapses, which would actually work if the interests were going back into the system. If it were a government, the government would spend that money on roads and bridges and the things that people need, and that could be used in the payment of interest, wages, et cetera, and then that could come back in the payment of loans. But that's not the system we have today. Today, the interest goes to shareholders or wealthy executives, or if it's part of the capital structure of the bank, it will go into more loans, which will be yet more loans at interest. So it's this sort of parasitic drain on the economy, always sucking more out than goes in. So inevitably, what you have is a debt overhang, because debt always grows faster than the real economy. So the real economy grows arithmetically in a straight line. That's goods and services. And then you've got this financial thing, this exponential function that only can happen in math, or in nature it can happen also in parasites and cancers. And what happens is that the parasite eats up its food source, and when the food runs out, then the whole thing collapses. And that's where we are. That's where it looks like we are now, and it certainly was where we were in 1929 and 2008. So how can we get around all that? Own the bank. This was a model that was actually first developed by the Pennsylvania colonists in Benjamin Franklin's time. So the colonists at that time had come up with this great system where they were issuing paper script. They didn't have to borrow from the Bank of England, which we now know was just issuing paper themselves. They didn't have to borrow from the goldsmiths. They just issued paper and spent it into the economy. But the trouble was, it was a lot easier to issue and spend than to pull it back. It was supposed to be an advance against taxes, but it was pretty hard to get taxes out of these frontiersmen, back in the wild colonial days. So they wound up inflating the system and deflating the value of the currency. But in Pennsylvania, they came up with a system where most of the money was being lent into the system. So they owned a bank, a publicly owned bank called the Land Bank, I just made up these figures myself, but just say theoretically that you issued $105. You're the creator of money. You issue $105. You lend $100 at 5% to the farmers. Then you spend the $5 into the economy, roads and bridges and things that people need. So now you have $105 out there, which all comes back as principal and interest, or it's available anyway. Then you can lend the 100 all over again, spend the 5 all over again, it all comes back as principal and interest. So you can do that over and over without hyperinflating the system. And in fact, during the period that system was in place, the colonists did not pay taxes, the prices did not inflate, and they had no government debt. So it was a totally sustainable system, and we could have that today. In the US, we actually have one such bank. I mean, not that, it's the Bank of North Dakota, not that they can issue paper scrip like the colonists could, but they can create money. As we know, all banks create money in the form of advancing credit. And so the Bank of North Dakota does that for the benefit of the people. It was set up in 1919 when the North Dakota farmers were losing their farms to the Wall Street bankers, and they wanted to keep their money in the state to be leveraged for their own purposes. So that's what they did. North Dakota currently has the lowest unemployment rate in the country, the lowest default rate on credit card debt, one of the lowest foreclosure rates, and they were the only state that completely escaped the credit crisis. Like, they never went in the red. But then people would say, well, North Dakota has oil, that's the reason they're doing so well. And so it was actually in response to that argument. I started writing about this back in 2008, after the 2008 crisis. And, but that would be the response, well, North Dakota has oil, and that's why they're doing so well. So I looked globally and historically at other public banking models, and that was why I wrote a follow-up book, The Public Bank Solution. It turns out, to my own surprise, 40% of banks globally are publicly owned. They're largely in the BRIC countries, Brazil, Russia, India, and China, which house 40% of the global population, and which also escaped the credit crisis, at least initially. I mean, every country's been dragged down by now. Okay. So I've got 2 minutes left, but I'm going to post this on my website, and all this stuff is in my books, which are actually on sale downstairs. But I'll do what I can here. Sure, that's right. Yeah. Okay, so the Bank of North Dakota model is that by law, all of the state's deposits are deposited into the bank, the state's own bank. It's set up as a DBA of the state, so it's set up as North Dakota doing business as the Bank of North Dakota. So technically, they have a huge capital base, and they have a huge deposit base. So then they leverage that money, as all banks do, as Wall Street is doing with our money, with most states' money. They leverage that into more loans for their own purposes. They've returned, on average, $40 million annually to the state for the last number of years, and which may not sound like a lot, but they're a state that's only about 50% larger than Portland. So it's a very small state. So that's a very nice return from so it's a big moneymaker for the state. They have a return on equity of 20%. There was an article in the Wall Street Journal last November stating that the Bank of North Dakota actually is more profitable than JP Morgan Chase and other Wall Street banks. And this is because they have very low costs. They don't have to advertise for depositors. They don't. Went there. They don't have to advertise for borrowers. What they do is they partner with the local banks. So the local bank acts as the front office, and the Bank of North Dakota is sort of a wholesale bank that just helps with capital and helps with liquidity. So they allow the small local banks to make loans that they couldn't otherwise make. They allowed them to escape the whole subprime crisis because they didn't have to sell their loans off to investors. And they don't have high-paid CEOs. They don't have shareholders. Their highest-paid CEO is, or their highest-paid person is the president, who makes about $240,000 a year. compared to 20 million for Wells Fargo. They don't do derivatives, et cetera. Done. Okay, so you can escape the credit crisis. You can actually leverage your money so that you can make money instantly, and the state or the city or the county could do this, make money overnight in ways that I have explained. I guess I gotta quit. So thank you very much.